Hi, this is Ankur Sharma. Welcome to this video where we're going to review a stock called F5. We're going to look at the numbers, we're going to check the earnings, we're going to check the fundamentals, we're going to check all the relevant ratios, we're going to do fundamental analysis, value analysis. Then we're also going to go and check the charts to see what the charts are telling for this company. Because first, if the numbers are good, we then want to see if this is a good time to buy or sell or hold. So let's go and take a deep dive on all these things. Let's get started. Welcome back. So let's jump in and digest the numbers first of all. F5 is got a ticker symbol FFIV, and you can see first of all it doesn't have any dividends. It doesn't pay dividends. It's a $1 billion company, founded in 1996, and what it does is, as you can see, it does mostly cloud-related service. Now let's see what else it can do for us. If you come down, price to earnings ratio is about 22.86, which is below 25. So it's not very expensive. It's on par, I would say. Now let's look at the numbers. So if you look at growth and profitability, their revenue has increased quite drastically. Net income has increased. Net margin has increased. So that is very good news. They have announced their results. Their earnings were good, EPS was good, revenues were good. Now let's go and check other things. So if you see, they make their money three ways: by using services, systems, and software. And where are they selling? They're selling to United States, EMEA, Asia Pacific, and other Americas, so emerging markets in Asia Pacific. So that's good so far. As we saw, it doesn't do dividends. Now, if you look at the financial health, there's something that is very encouraging. If you see their debt, the debt has been coming down quite drastically. And if you see, on other hand, the free cash flow has been increasing, which is excellent. Then if you look at the cash equivalents, that is increasing as well. Now let's look at the assets and liabilities. Assets is something that brings money into the company. Liabilities that takes money away from the company. If you look at long-term assets, are much, much higher than long-term liabilities. This company is in really great health overall from all angles, from debt angle, cash flow angle, assets and liability angle. So overall, if you see, total revenue is improving and is positive. Gross profit is positive. Operating income is positive. Pre-tax is positive. Net income is substantially growing. EBITDA is good. So overall, this company is doing very well and maintaining steady operating expenses, which is good news. Assets and liabilities, if you look at the net, total equity is increasing and is positive, which is very good. I like that. Let's look at cash flow. Free cash flow has been positive and increasing. Excellent, excellent numbers. If you look at the revenues, you can see majority of its revenues coming from services. And if you look at last time to this time, the services revenue, systems revenue, and the software revenue. Except software revenue, the systems and services revenue have improved. You can see that they've been steadily improving, and that is good sign. So that as compared to last year, overall, it is looking good, and majority of its monies are coming from United States, and then from EMEA, and then Asia Pacific. So overall, that is all looking great. If you remove the dividend, because it's not paying any dividend, that's the only one that is negative. All other things are looking positive. Now I want to look at the ratios to check the margins. Net margin, that's the number I was looking for. Net margin is 22%. Gross margin is 82. That's excellent. That's excellent. So health-wise, it's in good place. Yeah, all these numbers, but would like to see them below 1, which is all good. So overall, this is very good. Very, very good. But overall, I would say this company is in a great health compared to some of the other things I've seen. Price to earnings ratio is 22. That's good. Overall, I'm liking this company. I'm liking this company. Now, is this a good time to buy? That's the million dollar question. Let's go and jump in and check the values because it jumped 9% today. There is a temptation to go and look at this, take this chart, this stock today. But let's check the charts before we come to that conclusion, whether today is the day. So if you look at the charts, right away you can see it has a gap and it's hit that red line we marked on the chart long time ago. What is that red line? That red line is a resistance, which means if you go back in time, you can see it's hit the previous high right now. That means in the immediate short term, we should expect price to come down. And I would say the good price range to consider to enter into the stock if you're not in it is around here. So around there. Around there. You can even go a little bit below. So around this range, I would say it is good place to consider buying. Right? In that box, if the price comes to that area. Now, overall, in the very long term, this is looking very positive, and the long term, it could go a lot higher. It could go another $100 or so from here. So this is long term, 3 to 5 years time. It has potential to go to 325 to 400. It has potential to go there in the very long term. But I wouldn't chase it here. I wait for price to come down. And in the short term, it looks like it's going to sell off because anytime price hits this previous high, generally tends to sell off. And if it goes above this, goes up and then comes back to test this level, that is a good safe place to enter this trade. So at the moment, this particular stock looks excellent in terms of fundamental and value analysis perspective, but I would like to wait on this to get a better entry than chasing the stock. Do not chase the stock. It's not a buy or sell or hold recommendation, but it looks like it's got good future ahead. But I wouldn't chase the price. I would wait price to come to us. That's important. Price has to come to us. Let price come to you. Don't chase it. So if it comes into this area between 228 and 218, around there, between that, I would consider there's a buy. But long term, it could go a lot higher, provided there's no bad news. And I would watch the earnings and revenue. So any stock, if it continually produces 6 quarters of negative revenue or negative earnings per share, you don't want to trade that stock or hold that stock in your portfolio. So hopefully that was useful, and I'll see you on the next video. Don't forget to subscribe to this channel. I'll see you in the next video. This is Sanko Sharma signing off. Bye for now.